Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is July 17th, 2025. I am Luna.
I am JPMorgan.
Okay, let's dive straight into Wednesday, July 17th. Things started off with a modest uptick, but then, wow, midday drama hit.
That's right.
Major benchmarks like the NASDAQ, S&P 500, they did close higher in the end. The NASDAQ actually notched its 5th record close in 6 sessions.
Impressive.
But that smooth finish doesn't really capture the turbulence mid-session, does it?
Not at all. That midday swoon you mentioned, that's really the fascinating part. The S&P 500 nosedived. I mean, it dropped over 1% at one point.
And the trigger?
Well, the trigger was that rumor mill churning out stories that President Trump was maybe poised to fire Fed Chair Jerome Powell. And instantly you saw volatility spike, the dollar tumbled. It just shows you the market's reaction, how sensitive it is.
That quick, almost violent reaction just to a rumor.
Exactly.
Yeah.
It really underlines how crucial the perception of Fed independence is for stability. I mean, as soon as those rumors were walked back, denied, the market just snapped right back up.
Felt like everyone holding their breath collectively.
It did. It's a clear signal.
Yeah.
You know, investors really crave that certainty around monetary policy.
Absolutely. Okay, so beyond that political whirlwind, corporate earnings were, well, a real mixed bag yesterday. Highlighted some interesting cross currents, I thought.
Yeah, definitely.
We saw strong profit surges, like from Goldman Sachs, right? That helped lift their shares quite a bit.
Mm-hmm.
But then you had Bank of America and Morgan Stanley. They also reported higher profits, yet their stocks actually dipped a bit. What do you make of that kind of divergence?
It's a great question. And it really speaks to the nuance in these markets sometimes. It's not just about hitting the profit number itself.
Right, there's more to it.
Yeah, it could be about the outlook they provided, or maybe the sort of the quality of those earnings. Perhaps the market was just pricing in an even stronger performance, or maybe reacting to some subtle shifts in their guidance.
Okay.
On the flip side, you mentioned Johnson & Johnson, a huge jump for them, over 6%.
Yeah, quite significant.
And that came after they managed to slash their expected tariff costs. Clearly that pleased investors. But, it wasn't all positive.
Yeah.
Well, semiconductor stocks, for example, they cooled off a bit. The Philly chip index was down. That shows the sort of lingering bite from trade uncertainties, especially after ASML, a key chip maker, gave a cautious outlook.
Right, citing those trade issues. So it feels like we're seeing this pattern, solid corporate news trying to push things up, but it's constantly battling these bigger macro risks.
That's a good way to put it. These cross-currents are the market trying to balance solid company performance against these persistent background risks.
Okay, shifting gears slightly. What about other assets? Gold initially spiked on that Powell scare, the classic safe haven move.
Yep, textbook reaction.
But then it mostly pared back those gains once the political noise died down. Oil prices, interestingly, pretty flat through all this.
Yeah, little change there.
But then there's crypto. Bitcoin hit a fresh record high, didn't it? Around $119,333.
Briefly, yeah. And the broader crypto market saw a pretty significant rally, too. The CoinDesk index up nearly 4%.
So what's driving that?
Well, it's interesting because it coincided with the stock gains and that dip in treasury yields we saw after the initial panic. As some analyses pointed out, it really seems to reflect a wider appetite for riskier investments across the whole financial landscape.
So a broader risk-on mood, then.
Exactly. When even the more speculative assets like crypto are seeing that kind of confidence, especially after that brief jolt from the Powell rumors, it suggests a broadly risk-on sentiment took hold, almost like the market decided to double down on optimism.
Fascinating. Okay, let's ground this in some of the hard data that came out looking back at Tuesday, July 16th. First, the June Producer Price Index, the PPI, it actually came in flat, 0% change month over month. That surprised analysts.
It really did. And the yearly number, 2.3%, showed continued deceleration.
So what's the real takeaway from that soft PPI reading, especially for the Fed?
Well, this flat PPI reading is essentially, you could say, a bit of a green light, or at least not a red one for the Fed. It strongly suggests those tariff-related costs we've been worried about aren't really feeding broadly into pipeline prices just yet.
So less immediate inflation pressure.
Precisely. Which, eases that immediate pressure on the Fed regarding inflation fears. It buys them some crucial breathing room on thinking about future rate decisions and potentially supports bond prices and risk assets by tempering those fears of accelerating costs.
Makes sense. And then we also got June industrial production that rose 0.3%, which actually beat expectations.
Right, indicating some surprising resilience there, particularly in manufacturing. Capacity utilization even ticked up slightly.
What does that signal about the broader economy?
Well, that better-than-expected uptick, it reinforces hopes for that elusive soft landing everyone talks about. It definitely supports the no recession anytime soon narrative, suggesting the economy's holding up reasonably well, even with higher interest rates in place. Adds a layer of confidence, I'd say.
Okay, and finally, we got the Federal Reserve's Beige Book. That's their collection of anecdotal reports from businesses across the country.
Always an interesting read.
It described the economy as expanding slightly, but noted the outlook had turned more neutral to slightly pessimistic. And it specifically mentioned higher costs from import tariffs and businesses maybe postponing hiring or investment.
Yeah, and the Beige Book's cautious tone, especially flagging those tariff concerns alongside slowing growth hints, really highlights the dilemma the Fed is facing right now. Well, they're seeing inflation potentially nudged up by these tariffs, even as other signs point towards growth maybe slowing a bit. It complicates their path forward for rate decisions, doesn't it? Particularly after we saw how strongly the market reacted to that Powell rumor.
Puts the spotlight back on Fed independence and how they navigate these conflicting signals.
Absolutely. It's a complex balancing act.
So for you, the listener, trying to navigate these complex markets, what does this delicate balancing act really mean?
Well, I think the base case right now still leans towards cautious optimism. You've got inflation appearing to level off, growth showing decent resilience. The general expectation is still probably for the Fed to hold steady for a while, maybe with rate cuts coming sometime in 2025. But, and it's a big but, the last 24 hours are a stark reminder that key risks are very much still in play. Trade tensions, how corporate earnings hold up next quarter, and maybe most importantly, an unpredictable policy environment. Those can all shift the picture quickly.
Indeed. It really shows that while the underlying economy might be hanging in there, headlines can still pack a real punch.
They certainly can. And this raises, I think, a really crucial question for all of us navigating this. How do you proactively prepare for those sudden sharp swings in market sentiment, especially when political turmoil, like we saw hinted at, or maybe a sudden resurgence of inflation, could rapidly unsettle all the positive momentum we've seen?
Enjoy the brief? Please like and subscribe. From equities and bonds to global risk sentiment, we deliver day's key market moves, macro trends, and institutional flows in just 5 minutes. Live stream coming soon. Stay tuned.